Thursday, December 14th, 2017, Monaco 64, home of alternative economics and contrarian views. I want to talk about central banks, especially the Fed, and how, in spite of all the talk of Fed rate hikes, unwinding of balance sheet, that conditions are still very accommodative. And I'll prove that actually with a report from a top economist or top official at the Bank for International Settlements, Claudio Borio. He made these comments on the 3rd of December together with the BIS quarterly review, Bank for International Settlements. They are the central bank, the bankers for the central bankers. It's a supranational, above the law bank based in Basel, Switzerland. And before I go into that, let's have a quick look at what the markets are doing this morning. Spot gold has continued to trade up a bit. It's always, controlled. Some people think that markets that don't move more than 1% or 2%, that's not a spike, but for gold it is. Gold is completely controlled. I don't think it's very rare to see gold go up more than 1%. Very, very rare. Silver, goes up a bit more sometimes because it's more of a illiquid market. But anyway, gold is 1255.50, basically unchanged from the late close on COMEX. The range overnight has been 1259 to 1253. I think we need to hold 1250. That's a key level for gold, not only because it's a round number, but it's the 38.2 retracement, percent Fibonacci retracement from the low in 2015 to the high last year at 1377, 1250, key level, 38.2%. If we're not able to hold that, then we could go down to the 50% retracement, which is more near like 1210 or 12 the figure. Silver, 1605, down 2.5 cents. Range has been 1614 to 16. The Dow, the S&P, and the NASDAQ futures are all up this morning. The Dow is up 60 points, 0.25%. S&P 4 points, 0.16%. And the NASDAQ up 10.14%. Currency-wise, yeah, the dollar is a little, is kind of unchanged this morning, a little higher against the euro. Euro is down 10 pips, nothing really. The pound is up 11 pips, and the dollar is up almost 0.25% against the yen. So the dollar is kind of stabilized. But I want to talk about, this has got to do with the dollar. And I made a video a few weeks ago about, the stock market, how it just keeps making all-time highs. And what I had to say was that the reason this is happening is because despite the fact that the Fed has been hiking interest rates very gradually, and they're saying now they're going to unwind their balance sheet, the only reason I said stock markets and financial conditions were still, kind of good, is that the monetary policy is still accommodative, that they haven't done enough. And one of the reasons is that they've got this policy now of forward guidance, or trying to make sure investors, that they're not going to do anything that will hurt investments or markets, that they're going to do it very gradually. And yesterday, again, even though they raised rates, 2 of the 9 voters in the FOMC said they didn't want rates hiked, which was a bit of a surprise. So because they said that the PCE, or their measure of inflation, is not high enough. So you could see this PCE go lower, and all of a sudden they stop raising interest rates. And that's why, the stock market keeps going up. And it's not only me who thinks that, but it's the top guys at the Bank for International Settlements. and I'll go through the statement by Claudio Borio. He made this statement to the press on the 3rd of December, and it's the BIS quarterly review. And I quote this guy. It says, "It is as if time had stood still. Financial market participants had basked in the light and warmth of their Goldilocks economy in the previous quarter. They continue to do so in the most recent one." And he goes on to say the macroeconomic backdrop brightened further. The expansion broadened and gained momentum. Above all, despite vanishing economic slack, inflation, central banks' lodestar, generally remained remarkably subdued. So he goes on to say the risk-on phase intensified. Risk-on means, higher stock market prices, low bond yields, narrowing bond spreads. So he says headline equity market indices approached or surpassed previous peaks. And he compares what's happening now to some pretty bad events in the stock markets. He says, before the jitters towards the end of the period, corporate spreads narrowed further with U.S. high yield index. And by that he means high yield index means the index of junk bonds, basically. Flirting with levels, so the yield, high yields, they were going down. That means people were buying a lot of this junk. Flirting with levels not seen since the run-up to the 1998 long-term capital management crisis. So this crisis, Mr. Rickards was involved in this. He worked for LTCM, a hedge fund out of Connecticut. They almost brought the whole financial system down. The Fed had to bail them out, I think with $14 billion. All the investment banks had, they had lent to this hedge fund, basically. So they're in big trouble. Later, to the great financial crisis, you see, so junk bonds are at the highest level or lowest yield since the LTCM crisis and the great financial crisis of '08. Is he trying to tell us something? Emerging market economy sovereign spreads followed a similar, if less extreme, pattern. So he's also saying the emerging market bond spreads are narrowing as well. So, and he goes on to say, there would be nothing really surprising in this picture of, financial accommodation and higher stock markets, lower bond yields. If this picture were, there would be nothing really surprising in this picture were it not for one thing. All this ebullience has taken hold even as the Federal Reserve has proceeded with its tightening. So here we go. He's mentioning the same thing I mentioned a few weeks ago. Indeed, despite the announcement and the start of the balance sheet unwind, term premia have compressed further. Basically, the spreads, yield spreads between supposedly the risk-free rate of return, which is Treasury, and all the other loans or bonds. Granted, other major central banks have either left their previous accommodative stance unchanged, Bank of Japan, he says, or taken steps that, on balance, have been perceived as easing, at least relative to expectations. And he mentions the ECB. Even the Bank of England's 25 basis point interest rate hike has been seen as dovish, given accompanying communication. Basically, after the rate hike, the Bank of England said, we will probably only have another 2 rate hikes by 2020. So that forward guidance again, trying to baby the markets and market participants and telling them, if things get bad, we'll give you the dummy again, and you stop crying. And he goes on to say, but the Federal Reserve is the issuer of the dominant international currency, and its sway on markets remain unparalleled. To be sure, the beginning of the runoff in the large-scale asset purchases did appear to stop the US dollar's depreciation, which is a source of carry trades, he says. That said, the currency has actually depreciated too. since the beginning of the tightening at the end of 2015 when the Fed raised its policy rate. So he's questioning the same thing I question, in spite of the Fed being on a hiking or supposedly tightening policy for the last 2 years, the dollar is gone down, especially this year. And he goes on to say, hence a paradox. Even as the Fed has proceeded with its tightening, overall financial conditions have eased. And he goes on to talk about the Greenspan conundrum. That was when he started tightening, I think in 03. And rates, bond yields are still quite subdued and financial conditions were exuberant. And it led to, 2007, 2008, the conundrum. And he compares that to 1994, which I remember very well in the markets, when things were overheating and the Fed raised rates. The bond markets kind of collapsed, had a mini collapse in 1994. But back then, that's what central banks did. I remember the German M3 money supply that year was up by 30% year on year 1 month. And that was a huge event. I remember the Bund, 10-year Bund dropping like 3 points when the price was below 100. It was central banks back then did their job. Not that I think they do a good job overall. So, and he's saying now that this is a conundrum again. Even though the Fed is supposedly tightening, we're seeing the stock market up every day. Yesterday one of the reporters, I think it was the guy from CNBC, I forgot his name, but he asked Janet Yellen, aren't you worried, that the Dow keeps going up triple digits every day? Aren't you worried that, the price of Bitcoin is going through the roof? Do you, aren't things, and she basically said, she basically didn't really say what this guy said. And how does he end, he's basically saying that we have a problem here, a lot like, when Greenspan was around and the conundrum, we've got another conundrum. And he says, 2 things to consider. And I start first and most obvious, he says the jury is still out. There is a sense in which the tightening has not really begun. The vulnerabilities that have built around the globe during the unusually long period of usually low interest rates have not gone away. Second, a deeper question is what defines an effective tightening? Can a tightening be considered effective if financial conditions unambiguously ease? And if the answer is no, what should the central bankers do? And it goes on to say, in an era which gradualism and predictability are becoming the norm, these questions are likely to grow more pressing. So he's basically saying, the central banks have done this to themselves by trying to be too gradual. And the thing is, they can't be like in the past because they built a monster. They created a monster, which is all the trillions of dollars that they've printed out of thin air. I mean, just the Fed printed 23 trillion for TARP, another, almost 4 trillion in their balance sheet. And then you add up all the other central banks. We're talking tens and tens of trillions created out of thin air. How are you going to tighten conditions? It's going to bring the whole system down. But the problem is that by being gradual and trying to please the markets and tell them, oh, don't worry, we've got your hand, they're creating a bigger and bigger monster, all these financial, imbalances, and the stock market and the corporate bond spreads and the negative yields and the low interest rates. These are all a symptom of that. So, yeah, I'm not trying to scare people, but all I'm trying to say is that things are not normal and they should be careful. Be prepared for the worst in the financial markets. Just because we are here doesn't mean everything's fine under the surface. And for me, the best protection is to be outside the financial banking system with physical gold and silver. Yeah, cryptocurrencies are outside the system. They have gone up a lot. You know, Bitcoin was at 1,000 early this year. It is now 17,000. Be careful out there. I'm not saying I don't like cryptocurrencies, but yeah, don't mortgage the house to get into cryptocurrencies. So if you enjoyed this video, please like, share, subscribe to my channel if you haven't yet. And you can also follow me on steemit.com and on Twitter. I'll talk to you later. Bye.